Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's actually one of my favorite guests. I just love speaking to him. His knowledge and experience in markets is excellent. He's the editor and publisher of the Gloom, Boom, and Doom Report. Dr. Marc Faber, thank you for joining me again.
Well, thank you very much for having me on your program.
Now, Marc, I want to get your historical perspective about what's going on now with all the different markets and volatility. Does this remind you of what happened in 2007, or do you think what's happening right now with different markets and volatility is more like another time period that you've experienced in markets?
Well, I think we have to look at it from different perspectives. One thing is clear, that the debt level around the world today is actually even more burdensome than in 2007. And this is before interest rates go up substantially. They've already gone up, but they're still, by historical standards, very low, especially in Europe and in Japan. But once interest rates go higher, and there are some projections, as you probably heard yesterday, that by year-end, the 10-year Treasury will be at 4%. It is now a touch below 3%. If that would happen, if the 10-year Treasury note goes to 4%, I think this would cause a lot of disruption in the financial markets, notably the equity markets.
Now, you live in an emerging market. You live in Thailand mostly. I know you travel all over the globe as well. Would higher interest rates along with a stronger dollar? Now, I know a lot of emerging markets have an enormous amount of dollar-denominated outstanding debt. So do you think then that we could be looking at another tequila crisis type of thing or Asian tiger crisis if the dollar were to continue to strengthen against emerging market currencies?
Well, I think we have to analyze each country separately, because obviously the debt level is different depending on the countries. Some countries have a high level of dollar debt, and others don't have a very high level of dollar debt. Say, you take Russia as example. They don't have a high level of dollar debt compared to their GDP. And also domestically, the credit as a percent of the economy is not very high. So each country is a bit different. But in general, I think that today, with their large foreign exchange reserves, the Asian countries are actually in a reasonably good position to weather a tightening of liquidity.
So you think they learned from their mistakes then during the Asian tiger crisis compared to...
Well, in 1997 and 1998, before that, throughout the 1990s, most of the Asian economies had growing trade and current account deficits. That is not the case nowadays. Most Asian countries have actually a trade surplus. Plus, we have to understand, the Asian economies nowadays, unlike, say, 20 years ago, they are much more China-centric. In other words, their economies depend much more on their trade with China than with the U.S. All Asian countries, with the exception of India, have higher exports to China than to the U.S. So I think if the dollar strengthened further, it would actually rather be negative for the U.S., because one of the problems of the U.S. is that it is not particularly competitive internationally. That's why the U.S. has this large trade deficit. But if the dollar were to strengthen much more, obviously that wouldn't help the U.S. And also, if interest rates in the U.S. continue to go up, it would have a very negative impact on, say, the U.S. housing market. And it's interesting, today the stock market is up strongly, but most home builders are down on the day, which tells you maybe the market is beginning to smell that not all is that rosy in the housing industry.
And Mark, it's been estimated that there's over $10 trillion in U.S. dollar denominated debt for emerging markets. So that's large corporations in emerging markets, governments in emerging markets. So they've taken advantage of the ability to borrow cheaper in U.S. dollar terms, but a stronger dollar would really be onerous to them. Now let's talk about China since you brought them up. So China has had a large explosion in credit the last decade, but hedge fund managers like Kyle Bass have been betting on another large RMB devaluation. And while I agree with a lot of his fundamentals that China does have a credit bubble, he's been wrong about it, the timing of this trade for 2 or 3 years now. So do you agree with Kyle Bass that eventually China is going to have to do bailouts and devaluations of their RMB to deal with their credit bubble?
Well, I think that the credit bubble in China may resolve itself in 2 ways, either in a credit crisis, that is a possibility, but it hasn't happened yet. And the second way would be that the economy grows very strongly and that therefore debt to GDP begins to decline. That is also a possibility. And you raised the issue of the $10 trillion in credit that emerging economies have, in dollar-denominated credit. That is correct, but the GDP is also very large, all combined, and the growth rates in general are relatively high. I'm not saying that these growth rates cannot slow down, but say, I live in Thailand. I can see the country. It's not a very dynamic economy, but it can easily grow at 3-4% per annum, which by European standards and by U.S. standards is reasonably strong growth. In India, I think the growth can be around 6% per annum long term. The same for Vietnam, and so forth and so on. So the debt level is high, but we also have to analyze at what kind of growth rates these countries grow. And secondly, we have to analyze for what credit was used for. In many emerging economies, credit was used for infrastructure and capital spending. And that is desirable in a way. It's better than to use it all for consumption, as is the case in the U.S.
So, Mark, you don't think then that China, the problems they're dealing with now with HNA and Anbang are similar to what happened in the U.S. with Bear Stearns and AIG?
Well, I think there is a problem. There's no question about this, that some companies are over-leveraged and they have had some financial issues with wealth management products that are likely to be worthless. But in general, if I look at the Chinese tourists, they do not strike me as walking around with a large credit card debt. You understand? I think there is a big credit bubble, but the credit bubble is also offset to some extent by very large accumulated savings in the economy.
Okay. So the private.
But I mean, look. I think the issue here is: should you invest in China or stay out of it entirely? China is a country the size essentially 4 times the U.S. It's twice as large as the U.S. and Europe. It's going to be an important country regardless, whether they have a depression like the U.S. had in the 30s. After the 30s, the U.S. continued to grow, as you know, up to today, and stocks performed well. So I think in China, what you will have is economic fluctuations. We can have a recession possible, and the country is likely to continue to grow thereafter, and they have actually some very good companies that can grow substantially in the years to come. And if you came to me as a client, I would say to you, look, let's put some money in China and some money in India and some money in other emerging economies, because that's where the growth is going to be. And in some cases, the valuations are not particularly high. In other cases, the valuations are high. I concede that.
Yeah, I would agree with your assessment there. I think China is a mixed bag. So I think the Chinese state-owned enterprises, there's a lot of waste and misallocation of capital, and they're a larger fuel of the credit bubble, along with like Chinese banks, the government-owned banks. But the private sector technology companies are really healthy. So your Alibabas, your Tencents, your Baidus, those companies are in excellent shape, and they have, the Chinese government protecting them inside their own country.
Yes, I don't know to what extent the government protects them, but let's say there are some private companies that are well run and that have rewarded shareholders well.
So let's transition now to the 800-pound gorilla in the room, and that's, all these central banks, the 5 or 6 largest central banks on the planet, doing these liquidity injections. The Federal Reserve hasn't really expanded its balance sheet since October 2014, but the Bank of Japan, the European Central Bank, and the People's Bank of China have more than picked up the slack. Do you see a scenario where these other major central banks, Mark, are going to be able to meaningfully reduce their balance sheets before the next global financial crisis?
Well, I doubt that any central bank will reduce its balance sheet meaningfully. Meaningfully meaning, say, by 50%. That I doubt. Now, the U.S. is reducing its balance sheet, but at a very moderate pace. And it's still very large. And as you said, other central banks have come in and essentially continued to increase their balance sheets. And that then creates liquidity, and some of that liquidity flows into the U.S. and boosts U.S. asset prices and the dollar. To what extent they can actually withdraw, that I have some question marks about, because I think it would imply that the bond market would implode. And I don't think that after a period of ultra-low interest rates, the bond market would implode and not cause huge damage to the economy.
Now, Mark, if the Federal Reserve, it's planning on ramping up this quantitative tightening, which I think is a stupid name, it should just be called balance sheet reduction. It's planning on ramping that up to $600 billion annually. If they're going to sell these assets, who's going to buy this increase that the Trump administration needs for these large $1 trillion plus budget deficits and the assets the Federal Reserve wants to sell? Who's going to be the buyers then?
Yes, that's a good question. There is a certain pool of liquidity in the world, and I look, say, at stocks and the valuation of stocks, and then I look at the bond market, and if you tell me that I can buy a bond, say, at 4% yield, then I may be tempted to buy it. I'm even tempted to buy a 10-year treasury here at 3%, because I think that the U.S. economy is not accelerating on the upside, nor is the global economy, but actually I believe that within 6 months or so, we could be in recession. And if that were the case, then obviously treasury bonds would be quite desirable. They're not a good investment. 3% per annum for the next 10 years is not a very good investment, but it's probably better than to lose money in stocks if there is a recession. So I look at the bond market. Someone will buy the bonds, but maybe at a higher rate of interest. You understand? Someone will come in. If they can't sell the $600 billion that they want to reduce at 3% yield on the 10 years, someone will buy it at 4%. If nobody buys it at 4%, someone will buy it at 5% or 6%. There will be a time when people say, well, I'd rather buy bonds than hold cash in the banks, or I'd rather buy bonds than stocks. So at some level of interest rate, it will be cleared. But as I said, I think the damage to the economy if the 10 years yield goes to 4%, is huge.
Yes, and every 1% increase in interest rates on a national debt that's already $21 trillion is $210 billion in interest payments that the U.S. federal government cannot spend on other things. So something at some point is going to have to give. The primary dealers, Mark, to a certain extent, the government can force the primary bond dealers to buy up some of these bonds at auction, right? But they can't buy unlimited amounts unless the Federal Reserve is doing like some type of covert QE and giving the primary dealers the money to buy. But do you think then that the pension funds and the insurance companies, the government can force their bylaws, these very large pools of capital, to make them hold even more treasuries then at some point, if there is not voluntary buyers?
Well, it's again the principle of a free market, but they can kind of force them, yes. Or they can induce the pension funds to buy it if the interest rates become attractive. That's what I say. The situation cannot end well. Either interest rates will go up and damage the economy, and of course damage the credit market and also damage the homes market, the housing market, and the student loans and everything. But at some point it will clear. Now, my view is that the Fed in the U.S. will not reduce its balance sheet by $600 billion this year. Actually, I'm prepared to make a bet with you that they will not reduce it by $600 billion, that they will actually stop eventually with their quantitative tightening, or as you say, balance sheet reduction, and that they will have to actually increase their balance sheet simply because of what you said, that the U.S. Treasury on each 1% increase in rates has to pay more than $200 billion more in interest payments. So in other words, the deficit, which will go up anyway, will go up even more. And in that scenario, you're faced with either sharply higher interest rates, or the Fed and other central banks have to print money again, in other words, expand the balance sheet.
Yeah, I completely agree. I think in the near future, I don't want to put exact timing on this, if this is 6 months or a year from now or 18 months, maybe sometime in that time frame of 1 to 2 years, that if they do keep increase, I don't think the Federal Reserve can get away with the dollar strengthening, balance sheet reduction, and also interest rates increasing. I think, a combination of one or two of those things will eventually break something in credit, in one of these different credit markets, or it will pop an asset bubble.
Yes, absolutely. But the one thing I have to say, stocks are pricey. That is no question about this. But some stocks, they have lagged the market increase. In particular, if you look at oil prices, how much they've gone up, and then you look at oil stocks, how much they've gone up. Oil stocks have gone up much less than oil prices. And so oil shares around the world and oil servicing companies, as an example, Diamond Offshore or Schlumberger, they are probably quite attractive here.
That's an interesting idea. Mark, you're not worried, though, that there's record amounts of speculative long positions in oil futures contracts? You don't think that that's a sign that a top is coming in the near future?
Yeah, that worries me also. I think that is a problem that we have to live with. A top may come soon, but you understand, soon could be a month or 2 months away. But in general, I agree with you that whenever the speculators are heavily long something, like they were heavily long euros and still are, there is usually a counter move. Or the speculators, especially the small speculators, are very heavily short treasury notes and treasury bonds, whereas the commercials have increased their positions. So that would suggest that one should be careful about oil. But I'm suggesting that if you look at oil stocks at long-term charts, they look actually quite attractive.
Okay, because they have
oil strength, when the oil shares are strong, it's usually a sign of the end of a bull market. Oil stocks are very strong towards the end of a major bull move.
That's an interesting point. And also, if the oil price goes high enough, and the oil price has been in a big uptrend since the summer of 2017, a high enough oil price could be burdensome on the consumer, take away their discretionary income, and can crash the markets. We saw this. Obviously, the oil price was a lot higher in 2007, but I think that high an oil price above $130 a barrel did help accelerate the global financial crisis as well.
Yes, no doubt, whereby, say, consumer expenditures on oil nowadays are not as meaningful as they were in the 70s. But it's a factor. I agree with you, and the consumer is leveraged and in financially not a very good position because of his high debt level and because most of his costs of living are going up much more than the CPI would suggest. Let's say you look at your insurance premium, you look at rents that consumers have to pay, and so forth and so on, transportation costs, healthcare costs, all this. This is a huge burden on the consumer, and that's why consumption in the U.S. is relatively weak.
Yes, and also we know this from auto sales and retail and restaurant spending that the consumer is not doing these discretionary things. So while, these jobs reports with Trump are touted, the economy, the labor participation rate is still at record lows, and the economy is really only creating part-time jobs. But I like your trade idea with the oil market, Mark, because we're around $70 a barrel. These deep water offshore oil production is starting to be profitable again. So the companies that drill those wells or service those wells, they can start booking a lot more sales now. And, the oil producers then, I think maybe they'll be smarter and they'll hedge a more profitable oil price rather than risk, the oil price crashing and not be hedged.
Yes, correct.
So let's talk about volatility now. So it seems, with all these leverage trades, there's the leverage short volatility trade in stocks that hedge fund manager Christopher Cole of Artemis Capital says is $1.5 trillion in size. There's leverage short volatility trades in commodities markets as well. We had that brief volatility spike in February where the VIX went crazy. Today, when we're recording on Wednesday, May 9th, the VIX is back down below 14. Do you think that volatility, after taking a break the last couple of years, is back in here to stay?
Well, I think it will go up again at some point. Probably we've seen the lows last year. And I think in general, in 2018, you'll get much more volatility than last year. And that stocks will fluctuate widely, and that currencies will fluctuate widely, and bond prices as well. So as in general, the investors should be prepared that if they're wrongly positioned, that they could lose quite a lot of money.
Have you ever seen this much currency volatility before in this short a time? Because I remember reading that in the past, that a 1% to 2% move in a currency exchange rate in the past was considered a big deal, that was considered volatile. But now we have, that 1 or 2% moves in currency exchange rates in a day.
Yes. But, I've seen the Asian crisis, and the Asian currencies completely imploded at the time with a very brief period of time, and that was the highest volatility I've ever seen. But I think we could see volatility in currencies increase in the sense that if tomorrow, say, the Fed announced that they would no longer raise interest rates as they had projected, maybe 3 to 4 times this year, and that they would abandon their balance sheet reduction and in fact increase the balance sheet again. I can tell you, it will be interesting to see where the dollar is and where the price of gold will be. I think investors will gradually realize that all paper currencies are not particularly desirable. They are desirable on a short-term basis, that the euro moves up against the dollar and the dollar moves up against the euro. But in value, in terms of purchasing power, they're all going down in concert. And I think that at that stage when people realize, well, how do we preserve wealth? Stocks are expensive, bonds are expensive, in other words, interest rates are low. How do we protect ourselves in times of increasing volatility and in times of also an economy where the outcome cannot be favorable? You can look at it from each perspective, but I don't see how we're going to get out of the mess that central banks have created without upheaval. And at that stage, I think that investors will again allocate more money to precious metals.
Yeah, and central banks, as of right now, this is public. We don't know what their currency swaps are, but they have about 45% of global GDP on their balance sheets. So that's just this insane amount that they have.
Yes, yes. But they can go to 100%, or they can go to 200%. In Japan, it's more than 100%.
Yeah, I mean, if you would have told me that the central 10 years ago during the 2008 financial crisis and during the initial reflation trades and bailouts of 2009 that the central banks would have gotten away with this much, and a lot of people on Wall Street wouldn't complain, people on Main Street wouldn't complain that their stocks and their real estate, I would have been shocked that they would have gotten away with this much liquidity programs, not just the Fed, all the central banks. And a lot of people don't seem to care as long as their 401k is doing well and their housing price hasn't crashed again.
Well, you know, things work until they stop working. I mean, if you had told me in the mid-'80s that the government debt in the U.S. would go up to $21 trillion, I would have said, well, then we have massive hyperinflation. But it hasn't happened yet. And there are many reasons for that. But because it hasn't happened yet, does not mean that it won't happen in future.
Yeah, I completely agree. And also, Mark, the U.S. has been able to export a lot of that inflation. So they've gotten a lot of those dollars outside the United States, and they've kept a lot of that monetary inflation. They've kept it in the asset markets. So yes, we have inflation in the real economy, like you said earlier in the interview, but it's not the levels of hyperinflation, so most people don't notice it. So the Fed and the other people pulling the levers here have managed to keep a lot of that monetary inflation out of the real economy so far.
Yes, so far it's stayed out of the mainstream economy to a large extent. But as you pointed out, we had a massive inflation in asset prices. I mean, massive in home prices over the last 30, 40 years, in bonds and in equities and in collectibles and in art and so forth. I mean, that we have to see, and this is the dilemma and the problem of inflation. It doesn't occur in a linear way, and it doesn't occur evenly. So we can have massive commodities inflation, or we can have massive real estate inflation. And now we had a massive asset inflation, where essentially all asset prices, by historical standards, relative to incomes, are extremely high, extremely high.
Mark, are professional money managers that you talk to, are they selling stock positions, fading every stock market rally, drastically reducing their exposure to U.S. stocks?
Not really. And I want to tell you, the fund managers, they have a mandate. Their mandate is to outperform a benchmark. And the benchmark is given to them either in the U.S., if it's a domestic fund, the S&P 500, or the MSCI Global Index, or whatnot. And they are only interested in essentially outperforming the index. They're not interested whether the global economy will collapse or not. That is not their mandate. You understand? They can't say, if they manage a fund, well, I'm going to go now 30% into cash, because if they are wrong, they will lose their jobs. So the fund managers are not the ones necessarily you should ask about a lot of macro themes. Probably privately they all agree that it will not end well, but they're not paid to formulate an investment policy whereby it won't end well. They're paid to outperform the index every month or every 6 months or every year. The individual, on the other hand, you and me, we have money and we don't want to lose that money. And so we position ourselves also for economic and financial hardship. We may miss out on the upside if the markets continue to go up as they have since 2009. But it's like you miss out on some income if you buy an insurance policy, because it costs you some money, this insurance policy. But if you have a hardship case, a disaster, then you're happy to have the insurance policy. And so as an individual, you have to act very differently than a large fund manager.
And in 2009, Mark, you advocated for people to add to stocks, if I remember correctly. The mainstream financial media, mislabels you and incorrectly got this wrong. I remember speaking with you over the years. You've been advocating for, 1/4% bonds, 1/4% stocks, 1/4% real estate, and then the other quarter of one's portfolio in cash and gold mining stocks, right? So you've been kind of this. So that's been your portfolio balance for a long time, but that's not what we hear you mislabeled. You're incorrectly, in my opinion, mislabeled on the mainstream financial media.
Well, I have to admit that I wasn't very bullish about stocks after 2012. But in 2009, I remember I was interviewed when the market was at 606 on that very day, March 6, 2009. And I said, this is a buying opportunity because the market is oversold and the sentiment is very bad. And 3 leading strategists, economists, they were predicting S&P 400. Now it's the opposite. People say, well, the market will continue to go up forever. And the mood is very optimistic also about home prices going up and everything. Cash is basically trash for most people. But I think the way it was a good time to buy in 2009 and at the end of 2008 in emerging economies, the same way it is now a good time not to play the hero. The valuations are simply expensive, and you're going to have some exposure to equities, because if the disaster strikes, as I outlined, one way or the other, sooner or later, you may be off better in equities than in bonds and in cash. That may be the case.
So what do you think about the warnings that big name investors like Jeremy Grantham and Mark Mobius have been giving in the last couple months, talking about how in the near future they're expecting a stock market crash of 30% or more? Do you think they're going to be pretty early on the timing, or do you think it's smart to warn people to not try to get the exact top of the stock market and start taking profits out now?
Well, actually, I just wrote a report not long ago, and I explained that in my view, a crash was right now not very likely. Now, I rather think that the situation could be similar to 1973-74. The market at the time had peaked out in January, and then it was sliding a slope of hope for 2 years until December 1974. And the decline was continuously interrupted by powerful bear market rallies. The market kept on going up, but it didn't make a new high, except on one occasion in September 1973, remarkably, as they increased oil prices, the market went up strongly, but it didn't make a new high. But people said, oh, it's the beginning of a new bull market. But then, obviously, the disaster developed and interest rates went up and stocks went down and earnings disappointed and so forth. So I think that maybe we'll not see a crash, but we may see a long-term decline. I mean, basically today, at the current level, the S&P is still down almost 200 points from its high, 180 points. So the market may move in a trading range, but with fewer and fewer stocks moving ahead, and a larger and larger number of stocks breaking down.
Yeah, I think the stock market is putting in a topping process, but I don't think we're going to have a crash immediately. So a topping process could take 2 years, could take 3 years. But I think, we're having a lot of, the traders would call this chop, with the volatility where it's like 2% up one day, 2% down the next. And so people, the perma bulls that think that the stock market is guaranteed to go up, that they're going to buy every dip, the more volatility there is, the more 2% down days there is, the more of them that are going to give up eventually, being, perma bullish stocks.
Yes, I think the key is after 6 months or so, or a year, most investors will notice that they haven't really made any money in stocks. And then they'll become discouraged and trade less, and maybe some money will flow out of stocks into bonds, depending where the interest rate will be at the time.
So Warren Buffett has said that relative to bonds and interest rates that stocks are still undervalued. But, I think he's basically a hypocrite, and he's hedging his bets because Berkshire Hathaway has a record $110 billion in cash. So what do you think about what Buffett's saying versus what he's actually doing with his own money?
Well, I mean, strictly speaking, maybe there are some stocks that are cheap compared to bonds. I'd say in Europe, there are lots of stocks. They yield 4 times more than bonds. Same in Asia. We have a lot of shares in Asia that yield 2 to 3 times as much as bonds. So for that reason, I've taken, for instance, a large portfolio of Singapore REITs, REITs. They yield around 5-6%, and the bond yield in Singapore is slightly over 2%. And of course, these REITs, they will fluctuate. They will move up and down. The last few years, they were strong and a good investment. I think for the next 6 months or 1 year, you're not going to make any money on the upside in these REITs unless interest rates fall sharply. But at least you have this return of around 5%. And I think when people will look back at 2017 and up to 2020, if they can see that their portfolios have grown by 5% per annum, they will be more than happy, because a lot of people, in my view, will not make any money.
So this is not stock market related, but what are your views on this trade war that President Trump is pushing or escalating for the U.S. versus China?
I think it's a no-go. I think the U.S. has probably benefited more from trade with China than vice versa. And by the way, the Chinese economy is not such a closed economy as Trump claims. They have there's so many foreign companies in China that have done very well. Of course, they have transferred technology, but the U.S. 150 years ago also transferred technology from Europe into the U.S. and so forth. So this is an ongoing process, and property or patents and property rights, in the course of history, they are transferred from one people to another people, and from one geographical area to another geographical area, and so forth. I mean, someone invented the wheel, and then this technology of the wheel was transferred to other people. And I think the trade war is going to be negative for everybody. But possibly it will be most negative for the U.S. and not all that negative for China.
I think President Trump is going to claim a victory. Maybe the federal government will have more tax revenues, more U.S. corporations will come make investments in the U.S. with this trade war. But I have a lot of American farmers who listen to this podcast, and anecdotally, people who have boots on the ground, they are telling me that they are truly worried because if you farm soybeans or walnuts, or you're a hog farmer for pork, you could, if the Chinese slap a retaliatory tariff on you and you're a small business owner, your own government could claim victory, but your farm is put out of business. So there's going to be a lot of collateral damage, I think.
Well, I'd say, I would have voted for Mr. Trump. Don't misunderstand me. But I think whatever decision he will take and whatever agreements he will sign, it will always be a victory in his view. That we have to get used to. In many ways, he's actually clueless. It's like during his election, he was threatening to impose steel tariffs on China, and that Chinese steel would hurt U.S. steel mills and so forth. The imports of steel from China are about 2% of total U.S. steel imports. The bulk actually comes from Canada, from Mexico, Brazil, South Korea, and so forth. And for China, the exports of steel to the U.S. are less than 1.5% of its steel exports. So these are things that people don't realize. The U.S. is still the largest trading partner of China, but China exports to emerging economies, in other words, countries like Brazil and Kazakhstan, Russia, India, and so forth. They export to these countries far more than to the U.S. The exports of China to the U.S. are maybe about 20% of total exports. It's large, but China could live without any exports to the U.S. You understand? They can tighten their belt. It's not going to be good for the global economy, but they can tighten the belts.
And I also think that President Trump, while he's been consistent about blaming China for the trade war, he's basically about 30 or 40 years too late on some of his tariffs. Like what you said, I don't agree with tariffs, but, China was more dependent on those steel exports 30 or 40 years ago. So, him doing those things now is not really going to help anyone except for, maybe the small group of steel manufacturers here in the U.S. He'll tote up like a factory worker from Kentucky, a plant there, and, that'll be the political motive. That may get him re-election with the voters. But overall, I think a lot of Americans are going to be worse off from these trade wars escalating.
Correct.
Okay, so one more topic before the end of the interview. So let's talk about gold and Bitcoin and cryptocurrency. So do you think then the rise in Bitcoin and cryptocurrency, that it's taken away a lot of people that were interested in gold and silver, that because cryptocurrency like Bitcoin was doing so well, that people sold their gold and silver and went in and chased crypto?
Well, yes and no. The speculators globally are all essentially in cryptos. And I have to say, I live, say, here in the north of Thailand, in Chiang Mai, and 99.9% of the people here have never bought any shares or never bought any bonds or traded foreign exchange and so forth. And all these characters now are trading cryptocurrencies. And of course, they're all experts. And of course, I've never met in my life anyone who's lost money on cryptocurrencies. And this is not only happening here, but throughout the world. I had a journalist from Estonia contact me, and he said the whole country is trading cryptos. And it's not going to end well. Now, is it possible that the one or the other cryptocurrency will succeed? Yes. But for each one that will succeed, it's like for each mining company that succeeds, there are 99 that fail. And to know exactly which one will succeed and which ones will fail is not very clear. So I think that it is an asset class that is here to stay. It's like the internet stocks; they are still in existence, and personal computers are still in existence. Exactly which the surviving ones will be, I'm not sure. And everybody's an expert, but the experts don't know for sure either.
Yes, it's the Wild West, and there's fraud, and there's corruption and cheating.
There's a lot of fraud.
But most people aren't aware of this, Mark, and since you're in Asia, you would be, but a lot of Americans wouldn't be aware of this, that the majority of cryptocurrency trading volume is actually in Asia. So it's on the crypto exchanges in Japan and South Korea.
Yeah, it's huge. But you understand, Asians are gamblers. And they gamble on soccer, and they gamble on horses. They gamble on anything. And crypto has become kind of a casino. And lots of small investors are there, and they don't realize that there are some big syndicates that actually can manipulate the price. So I, as a speculator, I wouldn't particularly be interested in cryptos.
Yeah, I spoke off the record with an executive at a large commercial scale Bitcoin mining company here in the United States, and he said that there's enormous amounts of what would be illegal wash trading on Asian cryptocurrency exchanges, where, you know, crypto is traded back and forth from either the same person, their accounts one to another, just to create a higher, bid on the tape.
Yeah, sure. And everybody's like watching the tape of cryptos day and night, and they don't trade really on fundamentals, but on essentially market action, on technical factors. I mean, if someone wants to trade volatility, cryptos are wonderful, but I don't want to trade 24 hours cryptos. I'm not interested in, but I can see that as an asset class, there is some merit to it.
So the U.S. dollar is at least temporarily having a rally here. Do you think that gold and silver are going to hold up? I know you look at a lot of mining companies, so I don't think the miners, the primary gold and silver miners, can really cut more costs. They've cut the cost to the bone. I actually interviewed Nolan Watson of Sandstorm Gold, and he said the costs are going to have to rise because the miners are going to have to go spend money to replace their reserves on exploration. So do you think then that even if the dollar continues to rally, that gold and silver are going to hold up pretty good, and this is basically the bottom?
Well, I think the bottom was in December 2015, and since then gold is up 30%. And I think we are in a renewed bull market. Will we go up straight away like a rocket or steadily? My advice to investors is simply to hold some gold and not to worry about the price too much. Don't put all your money into gold and don't leverage your position. But with some gold, in my view, you will sleep well in the long run. This is the advice I have. Now, will the gold shares rally? They are very low by historical standards. Some of them are very inexpensive. And I think if the gold price went up 10, 20%, then some gold shares could double in price easily. But it may not happen tomorrow. But I'm not in a hurry, actually. I'm still buying gold, and I'm happy to have gold. Since 1999, it was a very good investment. Not as good as Apple and Amazon, but it was as good as the stock market, if not better.
Yeah, and that's the historical context that Warren Buffett and Charlie Munger, when they were bashing gold, were leaving out, because they mentioned since 1940 gold has been awful, but really since the tech bubble crash, gold and silver have still drastically outperformed the general stock market indices, right?
Correct, and what they refer to is indices. I think a lot of individuals would have done very well and better by holding gold in the long run than by losing money here and by losing money there. But look, I really have to leave you because I'm leaving tomorrow, and it's already late. So,
well, I want to thank you for your time, Mark. I always enjoy our discussions.
Well,
you provide great.
Thank you very much.
Okay, take care, Mark. I look forward to speaking to you again soon.
Yes, definitely. Bye-bye. Thank you.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone despite YouTube censorship, and hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.